Hello, this is Retta. Welcome to Rich Girl Math. We talk about investing for women. Nobody teaches women how to invest, so we do. Grab your bottle of water, settle in, and let's learn today. Quick disclaimer before we start, this video is for educational purposes only and is not financial advice.
If you don't understand index funds, you don't understand investing. That's not an exaggeration. It's the truth. Most people spend their entire lives confused about how the stock market actually works, and that confusion costs them hundreds of thousands of dollars. But here's the thing. Understanding index funds is simple, and once you do, everything else about investing clicks into place. So if you're ready to stop being confused and start actually building wealth, subscribe to this channel, because we're about to break down exactly what index funds are, why they beat almost every professional money manager out there, and how you can buy one yourself today. Let's start with the basics. What is an index fund? An index fund is a collection of stocks bundled together into one single investment. That's it. Instead of picking individual companies, you're buying a tiny piece of hundreds or thousands of companies all at once. Think of it like this. Instead of going to the store and hand-picking every single ingredient for a meal, you buy a prepared dish that already has everything mixed together. It's simpler, it's faster, and it works. Now the word index is important. An index is just a list of stocks that tracks a specific part of the market. The most famous index in the world is the S&P 500. That's the 500 largest companies in America. Apple, Microsoft, Tesla, Coca-Cola, Johnson & Johnson, all of them. When you buy an S&P 500 index fund, you're buying a tiny piece of all 500 of those companies at the same time. But here's where it gets interesting. Most people don't buy individual index funds. They buy index funds through something called a mutual fund or an exchange-traded fund, called an ETF. These are legal vehicles that hold the index fund for you. So when you invest money into an S&P 500 ETF, that ETF is holding shares of all 500 companies, and you're holding a share of the ETF. It's a layer of organization that makes everything cleaner and easier to manage. Let me give you a concrete example. Let's say you have $5,000 to invest. You could try to pick 5 companies you think will do well. Maybe you pick Amazon, Google, Microsoft, Nvidia, and Tesla. Sounds good, right? But what if Amazon has a terrible year? What if they lose 50% of their value? Your entire portfolio just got crushed. Now imagine instead you bought an S&P 500 index fund. Amazon is only a small piece of your investment. Even if Amazon dropped 50%, your overall portfolio would barely move because you own pieces of 500 companies. That's the power of diversification. And that's the first reason index funds are so powerful. But there's a second reason, and this one is even more important. Index funds beat professional money managers, and I'm not talking about most of them. I'm talking about the vast majority. We're talking 80, 90, sometimes 95% of professional stock pickers fail to beat the index over a 10-year period. Let that sink in. People who do this for a living, who have advanced degrees, who have teams of analysts and sophisticated computer models, they still can't beat the index. Why? Because the market is incredibly efficient. Millions of professional traders are constantly analyzing every single company, buying and selling based on the latest information. The price of a stock reflects everything we know about that company right now. When you try to pick individual stocks, you're essentially betting that you know something the rest of the market doesn't. And statistically, you don't. The market prices things correctly most of the time. But here's where it gets really interesting. Even the professionals who do beat the index, they usually only beat it by a tiny margin. And then you have to pay them fees. Maybe they charge you 1% of your assets per year. Over 30 years, that 1% compounds into massive underperformance. An index fund charges you maybe 0.03%. That's roughly 30 times cheaper. So even if a professional beats the index by 0.5%, after fees, they've underperformed. The math just doesn't work in their favor. There's a famous investor named Warren Buffett, arguably the greatest stock picker of all time, with a track record spanning over 6 decades. You know what he told his estate trustees to do with his money? Invest it in an S&P 500 index fund. Not in individual stocks, not in hedge funds, an index fund. If Warren Buffett trusts index funds, maybe you should too. Now let's talk about why index funds are so powerful over time. It all comes down to compounding. Let's say you invest $1,000 in an index fund that returns an average of 10% per year, which is roughly what the stock market has returned historically. After 1 year, you have $1,100. But after 10 years, you have $2,594. After 30 years, you have $17,449. After 50 years, you have $117,391. Your original $1,000 turned into over $100,000. That's the power of time and compounding. But here's the thing. Most people mess this up. They check their account balance every single day. They panic when the market drops 10%. They sell everything at the bottom and buy back in at the top. They try to time the market. And every single time they do, they lose money. The people who win at investing are the boring ones. They buy an index fund. They don't look at it. They let it sit for 30 years. They add more money to it every single month. And when they retire, they're rich. There was a famous study done by Vanguard that looked at investor returns versus index fund returns. You know what they found? The average investor underperformed index funds by over 3% per year. 3% might not sound like much, but over 30 years, that's the difference between having $400,000 and $2 million. 3% a year. All because people can't resist messing with their investments. So how do you actually buy an index fund? First, you need a brokerage account. A brokerage is basically a bank for investments. Popular brokerages include Vanguard, Fidelity, Charles Schwab, and Robinhood. You can open an account online in about 5 minutes. Then, you link your bank account, and you fund the brokerage account with money. From there, you can search for index funds. Let's say you want to buy an S&P 500 index fund. You would search for it, find one with low fees, and click buy. That's it. You own it. Now, when you're shopping for index funds, fees matter way more than most people think. Different index funds charge different fees. The difference between a fund that charges 0.03% and one that charges 1% might not sound huge, but again, over decades, it compounds into a massive difference. When you're shopping, look for something called the expense ratio. That's the percentage of your assets the fund charges you per year. Lower is always better. Vanguard and Fidelity have some of the lowest expense ratios in the industry. You should also think about tax efficiency. When you buy an index fund, you own thousands of individual stocks. Those stocks sometimes pay dividends or experience capital gains. In a regular brokerage account, you pay taxes on those gains every year. But in a retirement account like a 401k or an IRA, you don't pay taxes until you withdraw the money. So for index funds, tax-advantaged accounts are incredibly powerful. If you have a 401k through your employer, that's a great place to put money into index funds. Same with an IRA. Let me give you a concrete example of why this matters. Let's say you're 30 years old and you invest $10,000 in an S&P 500 index fund in a regular brokerage account. The market averages 10% per year. But you pay taxes on the gains. After taxes, you might only have 7% per year after tax growth. After 35 years, you'd have $130,000. Now imagine you invested that same $10,000 in an index fund inside a Roth IRA. No taxes, 10% per year. After 35 years, you'd have $580,000. That's $450,000 more. That's the power of tax-advantaged accounts. Now, I want to address one of the biggest misconceptions about index funds. People think they're boring. They think they're for people who don't care about investing. And yes, they are boring. Incredibly boring. But that's the point. Boring beats interesting. The stock pickers on CNBC who are trying to predict the next big move, they're entertaining. They're exciting. They also usually lose money. The person who quietly buys an index fund every month and ignores the news, they get rich. Boring wins. There's another benefit to index funds that people don't talk about enough, and that's the emotional benefit. When you own an index fund, you own the entire market. You don't have to worry about one company failing. You don't have to worry about making a wrong pick. You don't have to stay up at night wondering if you made a mistake. You buy it, you hold it, and you let time do the work. That peace of mind is worth something. Let's also talk about what happens when there's a market crash. Historically, the stock market crashes about once every 10 years, usually a significant drop. Sometimes a really big one. The market fell 57%. That was terrifying. People panicked. Many people sold everything. And you know what happened? They locked in their losses. The market recovered. It always does. And the people who stayed invested and kept buying index funds during the crash, they ended up with way more money. Here's a simple strategy that works. Every single month, you invest the same amount of money into an index fund. Doesn't matter if the market is up or down. You just keep investing. When the market is down, your money buys more shares at a lower price. When it's up, it buys fewer shares at a higher price. Over time, this averages out beautifully. It's called dollar cost averaging, and it's one of the most powerful investing techniques ever discovered. And it's free, and anyone can do it. So let me summarize the case for index funds. First, they're diversified. You're not betting on one company. Second, they beat professional money managers consistently. Third, their fees are incredibly low. Fourth, they benefit from compounding over time. Fifth, they're tax efficient, especially in retirement accounts. Sixth, they're boring, which keeps you from making emotional mistakes. Seventh, they give you peace of mind. And eighth, they're incredibly easy to start. But here's what I want you to understand. Index funds aren't a get-rich-quick scheme. They're a get-rich-slowly scheme. If you're looking to turn $100 into $1,000 in 6 months, index funds aren't for you. But if you're willing to invest consistently for 10, 20, 30 years, index funds are one of the most powerful wealth-building tools ever created. And that should matter to you. And I'd love it if you hit that like button to let me know this was valuable. Let me give you one more example to really drive this home. Let's say you're 25 years old. You invest $500 every single month into an S&P 500 index fund. You do this for 40 years until you're 65. $500 a month, every single month. That's $240,000 total that you invested. With average stock market returns of 10% per year, you'd end up with $1.9 million. $2.1 million actually, after accounting for the exact timing. You turned $240,000 into $2 million. That's not luck. That's not magic. That's how compound interest and the power of the market works. Now, I know what some of you are thinking. What if the market crashes and never recovers? What if we're in a bubble and it all collapses? First, the market has been around for hundreds of years. It's experienced wars, recessions, depressions, pandemics, and it's always recovered and gone to new highs. Second, if you're investing consistently, a market crash is a buying opportunity. You get to buy more shares at cheaper prices. Third, your timeline matters. If you need the money in 2 years, don't invest in the stock market. But if you don't need it for 10 years, a market crash is nothing to worry about. There's one more thing I want to cover, and that's the different types of index funds. There's US stock market index funds like the S&P 500. There's total market index funds that include every stock in America. There's international stock index funds. There's bond index funds. There's real estate index funds. The truth is, for most people, a simple approach works best. Just buy a total US market index fund or an S&P 500 index fund and hold it for decades. Don't overthink it. If you want to get slightly more sophisticated, you could do a mix. Maybe 80% in a US market index fund and 20% in an international index fund. Or 80% stocks and 20% bonds. But honestly, for most people under 40 years old, just 100% in a stock market index fund is the way to go. You have time on your side. Bonds are for people closer to retirement. Here's the bottom line. If you don't understand index funds, you're leaving money on the table. You're making investing harder than it needs to be. You're probably paying higher fees. You're probably making emotional mistakes. Index funds solve all of that. They're the foundation of any solid investment strategy. Whether you're just starting out with $500 or you're already investing, index funds should be your core holding. The wealthiest people in the world understand this. They use index funds as their core holding. They might have some individual stocks, some real estate, some other investments, but their foundation is always index funds. Because index funds are reliable. They're boring, and boring is exactly what you want when you're trying to build wealth. So here's what I want you to do. First, if you don't have a brokerage account, open one today. It takes 5 minutes. Second, if you don't have an IRA, open one today. That also takes 5 minutes. Third, fund your account with whatever money you have available. And fourth, buy an index fund. Just one. You can add more later, but take that first step today. The best time to start investing was 20 years ago. The second best time is today. I really encourage you to subscribe to this channel because we're going to keep breaking down investing concepts that will help you build real wealth. And then I want to hear from you in the comments. What's holding you back from investing in index funds? Is it that you're still confused about something? Is it that you're worried about losing money? Is it that you don't have enough to start? Tell me in the comments because I want to help you get past whatever is blocking you. Subscribe, and I'll see you in the next one.